Good morning and afternoon, everyone. I'd like to welcome you all to today's session, the sexy topic of protecting nonprofits from improper unemployment insurance payments. We're kind of geeking out about this over here because this is what we do all day long. My name is Max Smith. I am the Communications Director for 501c Services. Those of you who don't know us, we are a 100% employee-owned company, and we provide full-service unemployment outsourcing programs and other HR consulting services to more than 3,000 nonprofits across the country. Some of our programs include the 501c Agencies Trust, which offers unemployment claims outsourcing and reimbursing assistance for 501c3 nonprofits. We also have 501c HR Services, which is a consultation service that helps organizations like yours walk through difficult HR subject matter. Usually at this point, I say some of you are already working with us, but because the people who do work are already getting assistance on this topic, there is probably nobody on this call who is a customer of ours, but perhaps some of you will allow us to help you out in the future with this subject matter. Before I hand off the program to our trainer, Adam, I'm going to cover a bit of housekeeping, maybe answer some of your questions before we get started. As for the questions, Adam is going to take questions as he goes. So if you have a question, if it pops up, go ahead and shoot it into the questions area of the GoToWebinar browser. We will monitor those and we will answer those as we go. Some of them we will hold until the end, and you might find that your question is answered during the program, but we will address everybody's question. And Adam and I were talking about before we got on here, if we don't know the answer, we will make note of it and get back to you. So we will try to get everybody's questions answered today. If you're here for the wonderful HRCI or SHRM credit, you all know the deal for that. When we finish the program, a survey will pop up. Fill out the survey for me, which is required by those organizations. Let me know which credit you're after, and I will shoot those credits to you before the end of the week. So those will come to you via email later today or early tomorrow. As for the materials, everybody will be getting a recorded copy of this program. Everybody will be getting a PDF of the slides. So do not worry about that. I will send those to you as well. If you want the slides right now, they are in the handout section of the browser. You can go ahead and download them and make notes as you go if you want to be that type of, if you're that type of learning style. And last but not least, before I hand it off to Adam, we do have another webinar next month on leadership and how to do that empathetically. You all will get an email about that later this month, so please feel free to join us then. And I will go ahead and hand this off to Adam. Adam comes from our friends over at Thomas & Company. Thomas & Company actually handles much of the unemployment claims processing that our customers and clients utilize. So Adam is here. He's a corporate trainer for Thomas & Company. He's the expert, so I'm going to get out of his way and let him do his thing. Morning, Adam.
All right, thank you so much, Mac. I appreciate you inviting me to speak to everyone today. I'm really excited to share some great content, answer any questions that you have as we go through it. I've been in this industry for over 14 years. I've worked with many different industries, clients over the years within the unemployment process. So I know that everyone has different struggles and different strengths. And so really looking forward to helping enhance those strengths today with some great content. Just to go over a quick review of what we're going to tackle today. We're going to provide a quick overview of unemployment benefits. Who can file for these and when can they file? Along with what activities and roles the state agencies play in paying out these benefits and charging those back to employers. We'll also review the benefit payments made that are considered improper, which of course is our big topic today. What are those? How concerning is this issue? And what can employers do to protect themselves? Lastly, we'll take a quick look at the impact these improper payments can have on employer costs if left unchecked, as well as I mentioned, having a Q&A session. But again, just as Mac said, if you have any questions throughout today's presentation, feel free to type those in, send them. Mac will stop me periodically as we see those come in, but of course we will open it up at the end as well. So I guess before there is a payment of unemployment benefits, whether they're paid properly or not, someone must have filed a claim, right? So you've probably all seen or been involved in an unemployment claim at some point, or if you haven't, you probably will in the future. So it may make sense to start our conversation today with who can file for a claim and who is eligible for benefits in the first place. And we hear that question often: who can file for unemployment and when? The answer is simply that an unemployment claim can be filed by anyone at any time. So that sounds kind of crazy. You think, well, wait, don't they have to be fired? Don't they have to quit? And technically, anyone can go on a state's website, file for unemployment. Now, does that mean they're going to get it? No, absolutely not. But anyone can actually go and file for benefits. While specific details differ from state to state, there are overarching requirements that are consistent in all states. The claimant must be monetarily eligible, meaning that they have worked and earned wages over the past 1.5 to 2 years, showing an attachment to the workforce. And the reason is unemployment was designed for people who have a work history. It's not designed for John Doe who's never had a job before. They come to you, they're with you for 2 or 3 months, you're their first employer, they become separated and they file for unemployment. Well, because they don't have any significant wages in the past, they are not going to be monetarily eligible for these benefits. They must also be out of work through no fault of their own, which aligns with that primary reason the unemployment program was created in the first place. And lastly, they must be able, available, and actively seeking work. So those are some really important criteria that the state agencies are going to hold to when they're deciding, can a person actually collect benefits? I always like to kind of throw out some examples when it comes to that being able, available, and actively seeking work, are they able to provide time to your company in order to work? Or are they on a medical leave and the doctor has said, no, you cannot work for 6 months or 6 weeks or whatever it might be? So we want to make sure that we're gathering as much detail as possible on, are they able, available, and actively seeking work? And as I'm sure everyone on the call knows, many claims filed are unwarranted and might not meet these requirements. Those claims should be contested to obtain a disqualification of benefits to the claimant, or just as important, a non-charge to your unemployment account for any benefits that are paid out. So that's something that not all employers know, is there are certain situations where if someone is granted benefits from the state, depending on that scenario, an employer could still receive what we call a non-charge, meaning that you won't be negatively impacted by it. And while most employers understand they fund the unemployment system to pay these benefits out, they're not always aware this is a cost that they can control from year to year. So our objective today is to provide some key information that might help you do that. In the end, if this process is left unchecked, best practices not implemented, or you are partnered with a vendor who is not really focused on this as a core initiative, employers will more than likely see significant increases in their unemployment cost year over year. So a question that comes up: when someone does file a claim, what actions are taken by the state agencies? What is their role in this? We know that the person files with the state, but then what? So when someone files a claim, the state is going to essentially set up and freeze a benefit year and a base period. So think of it like someone files for an unemployment claim. It's like putting a stake in the ground and saying, all right, this is the beginning of my benefit year. Now, typically the benefit year is 52 weeks beginning usually on the Sunday of the week in which the claim was filed. So essentially, if they filed on a Wednesday, it'll backdate it a few days to go to the Sunday of that week. And then for the next 52 weeks, that is their established benefit year. So it's not a calendar year, it's not necessarily your company's fiscal year, it's contingent on when they actually filed with the state, and then going forward 52 weeks. During this 1-year period, the claimant would be able to collect, in most states, 26 times their weekly benefit amount. And some of you may have experienced times when you had someone who files, they collect for a little bit, maybe they come back to work, maybe they were out of work for a certain amount of time, and then 6 months later, maybe they're out of work again, so they file again. They're not essentially filing a new benefit year, so that's something I always like to clarify. They're still within that 52-week time period, they're just reopening the same claim. And why that's important is because when someone files a claim, it not only establishes that benefit year, it also establishes what's called a base period. And that's an actual time frame. So again, when that individual files for a claim, depending on what quarter they're in, that is what will establish this base period. And that's defined as the first 4 of the last 5 completed calendar quarters. Now, that's a mouthful. It's a little strange. It's unemployment only. So I like the chart that we have here because let's say someone filed a claim today. We're in the 3rd quarter of this year. Now, of course, the state agencies don't have all of your taxable wages yet. They don't have the wage information on the current quarter because we're still in the quarter. You haven't provided that to them yet. You might not even have last quarters fully in their system and able to use for benefit calculations. But they are going to have those first 4 of the last 5 completed calendar quarters. And so what they'll do is they look at all of the wages that that individual earned during that base period, and that is what will establish a formula for them, and every state has their own formula that they use. But that's what's going to determine how much someone can receive in unemployment benefits. So based on those wages, they could earn $300, $287, $562.42. So it does depend on how much they earned. Now, every state does have a minimum and maximum benefit amount, and that range is pretty wide. But again, just to illustrate that you do have people that have wages in that historical time period, which is also why when you are responding to an unemployment claim and the state is asking for something that happened over a year ago, a common question we see is, why are we being asked about this? They haven't been employed with us for so long. Do we even care about responding to this? And the answer is a resounding yes. You do want to respond because, of course, as we're learning now, those wages could have happened in the 2nd quarter of last year, and you could potentially be liable if you don't respond to the state. As you might recall, I mentioned on the last slide that there must have been some attachment to the workforce, right? So again, when we look at the base period, the state will look at, do they have sufficient wages during that base period? And again, if they don't, they're not going to be monetarily eligible. But of course, as time goes on, they do earn more earnings. Maybe next year, if they filed a new claim, they would have significant wages in the base period. In many states, if sufficient wages were not earned, they could even look at what's called an alternate period of time or an alternate base period, such as the most recent 4 quarters. They can review those to see if they might qualify under that term. Many times we'll see that with people in the military, where they could have been in the military during the base period, and then they got a job and they don't have significant wages, but they'll look at an alternate time period. So that's a possibility. So what does that mean for claims? We're looking at these different types of periods. So it's at this point that the state will issue claims to the last separating employer. So again, we're on the far right side there in the 3rd quarter of this year. Whoever that person separated from, they're going to get a claim. And all employers the claimant worked for in the base period. So they could have worked for 3, 4, 5 different companies in this window that we're looking at here, this 18-month or year-and-a-half window, and every employer is going to receive an unemployment claim. So that's going to decide not only if they're going to get benefits by looking at that most recent employer, but again, who are we going to charge? After getting a response to those claims, the state agency will make decisions on, again, both the payout of benefits and which employer will be chargeable. Now, typically that last employer or separating employer is, again, what will determine whether they're receiving benefits. But then, of course, the state needs to figure out, okay, who are we going to charge? So our focus today will specifically be on these benefit charges to your accounts and the accuracy of them. So when we talk about these charges being made against employers and benefits paid out, how do the states go about doing that? Well, we talked about that a little bit, but of course, it does take some individual processes with those state agencies, and sometimes they use different methods on how they're charging employers. And what's important to understand first is what we mean when we speak of unemployment claim liability. So this is the potential monetary risk an employer has associated with the payout of benefits to a claimant. So as benefits are paid out to a claimant, an employer's unemployment account is charged with their share of benefits. Now, of course, as a nonprofit employer who has chosen the option to reimburse the agency dollar for dollar for paid benefits, as opposed to paying taxes to fund the system proactively, these charges are, for all intents and purposes, your bill. There are three main methods for charging employer accounts: proportional charging, and that's the distribution of liability to employers in the base period based upon their proportionate share of total wages paid to the claimant in that base period. So we kind of looked at that chart on the previous slide, and like I said, there could be multiple employers within those different quarters that fall into the base period. So obviously, if there was just one employer and you're the only employer during that entire time, you would get 100% of the charges. However, if there were multiple employers, and let's say you paid out 60% of the total wages in the base period, then that employer's account would be charged 60% of any benefits paid out. So again, the proportion of wages is equal to the proportion of benefit charges that you're potentially liable for. Now, when it comes to the inverse chronological order, which sounds very crazy, I know, but again, they look at that base period and they actually charge the employers from the most recent employer in that base period their full amount. Then they go to the next employer in the base period, charge them full amount, and so on and so forth until either the benefits are completely paid out or until that person has stopped filing for benefits and is no longer receiving those from the state. So for this reason, it's not uncommon that many employers will see someone show up on their benefit charge statement over 2 years after they originally receive a claim. You'll also have the last employer states, where they're charged, usually the last or separating employer, as defined by state law, is charged 100% of the benefits. An example of this is the state of Illinois, where the chargeable employer is the employer for whom the claimant most recently worked 30 days or the employer who re-qualified that claimant following a disqualification. So Illinois has and uses the same base period we discussed earlier to calculate the benefits to be paid, yet charges the full benefit paid out to this one chargeable employer. So again, kind of a strange look at that, but essentially if you are an Illinois employer and you have someone on staff for 30 days and they go and file for benefits, if they're found eligible, you could be potentially liable for all of the charges, even if most of their wages came from somewhere else. Now, on the flip side, if you had someone on your staff for 2-3 years and they go and find another job in that state and they're with them for 30 days, or again, they re-qualify with them, then they would be liable and you would not. So it does kind of just depend on the scenario. States like Georgia, Virginia, Kentucky have very similar charging methods. I always suggest identifying these states and make good use of probationary periods that align with those regulations and determine whether or not the employee is a good fit prior to the deadline for being defined as that last employer.
Hey, Adam.
Yes.
So we have a question from Yvonne. She's in Michigan, since we know everybody has different rules. Her question is, based on these scenarios that you gave, she's wondering if an employer could bear the majority of a benefit claim, even if the employee only worked for them for a short period of time, like almost a month. Is that correct? Okay.
So yeah, great question. So again, depending on what state you're in, like you said, Michigan, so those wages can absolutely be calculated into your potential liability. Now, if they're only with you for 3 weeks, your potential liability is going to be very small. It's not going to be a significant proportion of that, but yeah, it could be that, let's say, you only paid them a certain amount, and when the state does their calculations, you only paid 3% of their total wages during the base period. So what that could mean is for any unemployment benefits they receive, you could be potentially liable for 3% of those. So yeah, it does matter. Everything breaks down into the wages, but again, your liability would be very, very small. And that's in that example. Great question. Right. So here's another question to think about. Is it safe to assume that if there are benefits improperly paid out for some reason during these processes, employer accounts are being overcharged? Well, these days, that's the billion-dollar question, literally. And the answer is absolutely yes, unfortunately. Improper payment of benefits are the main driver of erroneous charges to employer unemployment accounts, which ends up significantly increasing costs for employers. So in short, an improper payment of benefits is a payment made to someone incorrectly, right? And when this happens, an employer's unemployment account is usually overcharged, which has a negative impact on their total cost. So then, of course, you might be wondering, well, how big of a concern are these improper payments? Is this something that I really need to look at? Is this really impactful? So, of course, to answer that question, we have some different analytics, different views that we can look at here. And the answer is if we round up to the nearest percentage, it's 24%, or roughly 10 billion with a capital B in calendar year 2021. So looking at this chart, breaking these percentages down by state, anything yellow or red is higher than the national average of 2019, when the percentage was around 10%. Those in red are over 20%. So of course, if anyone on the call today is in these states, obviously that's definitely a concern. Obviously, everyone would like to see more green on the map as we slowly but surely get back down to normal volumes. Unfortunately, the pandemic exposed a great deal of weakness in the systems and processes, which has driven a lot of this concern. Of course, a lot of the state agencies, as no one's going to be surprised at, were very overburdened with unemployment claims that occurred during the pandemic. They couldn't keep up. There was huge lag times. They were trying to pay out benefits as quickly and not always as accurately as they could. And so the good news is that, because of that, many states are currently modernizing their systems and processes to address and mitigate many of these issues. So they're doing a lot of cleanup right now, but hopefully it will help for any future issues and just have a better process going forward. However, that is going to take quite a bit of time, and employers need to be watchful of these erroneous charges in the interim. This is why benefit charge auditing is critical to controlling these costs. By cross-referencing these charges with unemployment claim activity, these erroneous charges can actually be protested and credited back to employers. When the state agencies send the benefit charge notices, or what we referred to earlier as the bill, reviewing those in detail is crucial. And as you can see on this chart, the trend of improper payments is really nothing new. This has been something that's been around, it's been looked at, but improper payments, is something that is always important to keep tabs on. Given the complexities of unemployment, mistakes are going to happen. Prior to 2011, especially during the Great Recession, improper payments grew to roughly 18% nationwide. At the time, much of this was attributed to the state agencies not getting timely and complete information from employers at the time a claim was filed. So as a result, the government stepped in and the UI Integrity Act was passed. And with the passing of that legislation, higher employer compliance and a steady decline in claim volume, the error rate did come down and remained fairly stable over the years, falling below 10% in 2019. Obviously, with the overwhelming volume of unemployment claims associated with the pandemic, the ease of many restrictions and requirements for collecting benefits, and also the unfortunate increase in fraudulent activities associated with identity theft and imposter claims, you can see this percentage has more than doubled nationwide in the past 2 years. Knowing that benefits paid out are going to eventually be replenished by future employer payments, I've always viewed an overpayment in benefits as an overcharge to employers in some way, shape, or form. As you can see in the quote on the slide from a recent article, the Department of Labor considers this a serious issue and have added it to their high-risk list to develop a plan. And of course, we always continue to monitor these activities and keep clients up to date. So of course, I'm sure most employers would like to know the reasons behind these errors and who is responsible for them. When we take a deeper dive into the causes of these improper payments, 3 issues really stand out. Separation issues, which account for 29% of the improper payments, are basically the state being provided with a reason for separation that would allow benefits, such as lack of work, and as it turns out, the person was actually terminated for cause or voluntarily left work for reasons not attributable to the employer. Benefit year earnings occur when benefits are paid out while a claimant has earnings that would otherwise have disqualified them. And this often happens when an employee is laid off and returns to work, but doesn't report their current work status to the state and continues to collect benefits. Other eligibility issues arise from refusals of suitable offers of work. So of course, if you're trying to give someone shifts and hours and wages and they're refusing, we always recommend that that is documented. Keep track of when that offer was made, who made it, what were the terms of that job? Was it a 3-week assignment? What was the rate of pay going to be? Was there travel involved? Because those are very specific details that these state agencies will look for if they're trying to determine, should we allow benefits during the time that work was available? And many times, if you have that supporting information, you can be protected from any benefits that they could have accrued during that specific time period. So we can make sense of these top 3 causes, but let's also walk through 2 additional big causes: work search and being able and available. I referenced that a little bit earlier, but one of the requirements significantly relaxed during the pandemic was associated with a claimant needing to search for work. When those policies were reinstated, I believe there was quite a bit of confusion related to these requirements and also not necessarily a strong enforcement of those policies. So some of you may have remembered during the pandemic that state after state after state was postponing or just stopping the work search requirements during that time. And then of course, when it came back, people weren't exactly sure what to do. Is this something we now have to track? And are they actually going to enforce it? As it relates to claimants being able and available for work, I can only assume that that was mostly due to COVID-19 specific issues used as a reason to hinder a person from being able to work. I also think it's important to note here that the states were under a lot of pressure to pay benefits out and to do so quickly without the investigation into issues that they might normally do prior to the pandemic. So again, Everyone remembers you saw your claim volume skyrocket during the pandemic, and the state agencies were really struggling. They were making a lot of mistakes. They were just trying to get things processed, get money out the door to people that needed it. But of course, there were people that shouldn't have received it. And you know, it's human nature to need a bad guy to blame when errors happen. We all need to know who's at fault. And it would be interesting to really break that down. So that's what we've actually done. Now, this may shock many people on the call today. It definitely did me when we looked into the numbers here. And so if we see this, you know, who is responsible for this occurring? And we're all surprised on the high percentage associated with the claimant only category at a staggering 80%. And as we compiled the data for this session, I for sure thought it would be a much higher percentage for the employer and the state. Well, I suppose there's enough blame to go around for any improper payments. You know, with 42 million claimants filing for benefits following the start of the pandemic, it does make sense. You know, people who had never filed before, didn't know how to do it, maybe included some erroneous information, just, you know, made mistakes because, again, they were just trying to go through the process. Some computer systems were crashing with the state agencies because, you know, they couldn't handle the volume. So, of course, mistakes did happen. There was tremendous pressure to make benefits available. So we want to really, you know, keep in mind that there was a lot going on with all parties. So what is really needed now is a strong effort to get these improper payments stopped and eliminate the potential going forward to mitigate the impact on employer costs as soon as possible. So what's the next logical question that could come up? Is there anything employers can do proactively to address or prevent these improper payments? And what else can you be doing? First and foremost, do not ignore claims that are filed. All claims have a deadline for a response set by the state agency. And those states do really hold those deadlines in a very important status. You know, late responses can cause issues down the road that could either penalize you from appealing. If you lose that claim, there could be monetary fines. So we want to make sure that we are keeping track of everything that comes in and making sure that they're responded to timely. It's important to meet those deadlines so that, you know, again, those appeal rights aren't lost in the event benefits are awarded. It's also incredibly important to provide sufficient details pertaining to the separation issue as well as relevant documentation, because that's going to provide the agency with the information they need to make an informed determination. You know, sufficient information is something that people struggle with sometimes. Well, what do we really need to provide? You know, they quit. They should be automatically denied benefits if they quit, right? Definitely not. We want to see, are they providing resignation letters? Do we have statements from the employer? In a discharge case, you know, do you have prior warnings that are documented? Do you have witness statements that can be provided on the final incident that caused the termination? Did you have them sign a company policy acknowledgement? So there's a lot that goes into it, more than just responding timely, which is critical, but also, are we providing what we need to the state agency so they can make that fully informed decision on whether or not they should get benefits and should your company be charged for it. And actually, I just happened to notice a question pop up, and that was perfect timing. Can a former employee collect benefits if they resign? So yeah, and I'll even expand on what I was talking about a little bit. So you can have someone who resigns for any reason and they file for benefits, but the state will put that burden of proof on the claimant if they resign. So they'll be asking things like, okay, why did you resign? And if they say, well, I quit for another job, well, in pretty much every scenario, that one's going to be denied benefits. If they say, well, I quit because my employer kept cutting my hours, or they cut my pay, or they cut my health insurance, or whatever it could be. Well, now there is the potential that there could be something that the employer did that made it an unsatisfactory workplace for the employee. However, they also have that burden of proof to show the state that they exhausted all opportunities available to them prior to quitting. And what I mean by that is, let's say they had whatever issue it was, and they just said, well, I don't like this situation, I quit. I'm walking out the door, or I'm giving you my notice. And they don't actually give you as the employer an opportunity to address that situation. Well, in that instance, they can be denied unemployment benefits because the state does want to see that they gave the employer an opportunity to address it and give some type of resolution. It could even be, are they in a safe working condition? If they are working on a piece of machinery and that machinery starts sparking or shooting bolts out everywhere, did they go to maintenance? Did they let their supervisor know? Were they able to be placed on another part of, in the building and do something else while it got repaired? Or did they just say, oh, I don't like this, I quit? So those details are what will determine in those resignation cases, what happened. And so collecting all the details, again, if any of those situations happen, document them. That's very important. We have to not only have the reason that they resigned, but if you want to protest it and convince the state agency that you did everything you could to keep them on staff and they still quit, that will help your case greatly. Let's see, saw another question come through. I am new to my company as an HR generalist. My company works in multiple states. I'm having a lot of issues with getting access to the state UI account. Is there a best practice to get access to these websites? So yeah, every state has, obviously the website like you mentioned. One recommendation, and I don't know your specific case, but one recommendation is, every account has a power of attorney associated with it. So your company should have power of attorneys associated with every unemployment account. And many times that is connected to a login on a site, or there should be a username that someone has. So it might be beneficial to make an inquiry into those state websites. Usually there's some type of help that's available. But I would really try to use their help desk or any type of communication with the site. But if you do know anybody internally that is in charge of your unemployment payments, like accounts payable, maybe they have an access point, but it will also be connected to the power of attorney who has the legal authority to have access to that information. I see, what if the former employee was granted a large severance payment? Would that jeopardize their unemployment? Another great question. So, and again, this is actually going to be state by state. So some states will disqualify benefits during a time when severance is paid out, or they might even look at how long that severance is paid out, or even if it's a lump sum payment, they may just disqualify them for that week that they received the payment. They may look at it and say, well, it's a lump sum, but it's actually for 3 months. So we may not grant this person benefits for 3 months until that severance runs out. Then you have other states that don't care at all, and they'll say severance has nothing to do with unemployment benefits. So you do want to research what state you are in and look at the impact. You can usually find that on your state's unemployment Department of Labor website, so that you can ask those questions as well. But so not a clear answer, but it does depend on what state you're in and how they look at severance payouts and whether or not they determine if it's disqualifying income compared to unemployment benefits. All right, great questions, everyone. Thank you so much. So we left off with talking about providing the separation information, right? Another step, make sure to audit your charge statements. Again, we talked about that bill when it comes in and it says, okay, for this time period, could be a quarter, these are the people that were found favorable. Your company owes money for each person. So it's probably a good idea to know where they're going within your organization. That's step one. Often these documents are not clear regarding the information on them and end up in a variety of departments. So some don't really get much attention if the recipient isn't sure where they belong. And as we've mentioned, for reimbursing employers, this is your bill. So chances are you do have a designated person receiving them, or hopefully you do. And it's important to go forward with paying the amount that is due to avoid possible penalties and interest. However, know that you have the same right to protest as any other employer if you think a specific charge might be an error. So pay your bill on time, but of course audit those. And if you see any that are erroneous, you can protest those. And if it's favorable back to you at that point, these should show up as credits on future billings. And review these statements for potential errors. We've listed a few of the more common issues, including being charged for someone who never worked for you. Social security numbers and state and federal ID numbers can get transposed, so it's not uncommon for you to be charged for someone that didn't even work for you. Another process that should not be overlooked is the completion of wage audits. I know that many vendors out there shy away from these documents due to formatting issues or data required, etc. But these are also very important to manage. The states randomly audit benefit payments each quarter. When they detect benefits paid and earnings reported, they generate a wage audit to determine if this occurred during the same weeks. This is designed to reduce the amount of improper payments due to the benefit year earnings reason we spoke about earlier. So some of you may have had a little flag pop up in your head as I'm talking about this, because it's almost like this last point borders on unemployment fraud, right? Well, we want to address that as well. And as a matter of fact, it does. Many of the improper benefit payments out there are fraudulent in nature, including issues where false information is provided by either a claimant or an employer, wages aren't reported while collecting benefits, or a claimant continues to collect benefits after they return to work or take on a new job. However, what is getting most of the headlines today are the fraud claims being filed as a result of identity theft. So you have cyber criminals using this data they may have acquired through unprecedented data breaches over the past few years, or that they have acquired on the dark web. Employers should question any suspicious activity to ensure these benefits are not charged to their accounts. If they get a claim for someone currently working, ask the employee if they filed. If not, respond to the state with a potential fraud issue. So sometimes that feels weird, right? Well, I got this claim for them, they're still working. Should I ask them? Is that going to be weird? But fraud is such a big issue. And if they are a victim of identity theft, they will be very appreciative that they were alerted to it so they could take the proper steps to coordinate with the state agency. They could start their process if they need to, freeze their credit or cancel credit cards, whatever. So yes, it's recommended to follow up with them, say, hey, we received this unemployment claim, just want to make sure that you did file it and we can respond. Because you never know why someone files. Maybe they have two jobs and maybe one job is with you, they have a job with someone else and they lost that job and that's why they're filing. So it has nothing to do with your company, but because you paid wages, again, remember, I'm going to go back to our base period and our most recent employer. So because you show up as an employer within that time frame, you're still going to get a claim request. So double check. And if they say, oh my gosh, no, I never filed a claim, that's crazy. That's when you want to alert the state agency and respond to that claim quickly with a potential fraud issue. And each state does have their own fraud units with personnel dedicated towards resolution and remediation of these issues where it's necessary. All right, well, I know we have gone over a lot of information and I had some great questions already. I do want to open it up again. If anyone does have any questions that come through, I would love to address those at this time.
That's a really good question that just came up.
Yeah, I was reading through it, so I'll say that for everybody. I work for an organization that used the same EIN as the Diocese of Helena. Recently, we separated and obtained our own employer identification number, is what that stands for, and obtain an account with unemployment insurance with our new EIN. However, I have observed that some past employees are being potentially charged to our old EIN. What would you recommend to get this addressed? Yeah, so that is an interesting scenario when it comes to getting new accounts. It will also depend on, how that, and I'm trying to look if that was a merger acquisition type of separated. Okay, so it's a separation. So it does kind of depend on how that separation occurred and if you pulled that liability from the past EIN into the new one. Because many times, if that's the case, if you pulled that experience or that old liability with you, then you could still potentially be liable for those past claims, even though it's a new account number. What's important to do is when you respond to the state, include those details of the date of the new account was created. But it would be beneficial for you to look into the relationship of, are we still liable for the experience? Because when that new account number was created, that would have been part of that process. So whoever was involved in creating the new account and reporting that to the state agency, that's who you want to work with to see, do we still have liability from the past? But you can also, when you respond to the state, let them know this is a successor account number. This is when they started to fall under our new EIN. And that way you're checking internally on what you did, also letting the state know, hey, this is when a structure changed within our company, and this is what it looks like, and this is where their payroll was, this is where their payroll is now, and then the state can also figure it out on their end.
I can answer the next one if you don't want to.
Yeah, absolutely, go for it.
So Krista asked, is having an insurance company manage unemployment payments a good option? What Krista is talking about is that if you're a 501c3 employer, you can choose to remove yourself from the state unemployment claims program and basically create your own. And then as Adam talked about earlier, what happens is the state sends you bills for each claim that's processed for your past employees. What Krista is asking about is some nonprofits will actually have an insurance company write them a policy, and that policy pays the unemployment claims for them. The main reason in our experience, Krista, that nonprofits do this is because they have a leadership team that likes to know exactly how much money they're going to spend on unemployment for the year. So they get an insurance policy, they know exactly what their premium payout is going to be for the year, and they can plan for that accordingly. And then when claims come in, that insurance policy kicks in and pays the claims. So in our experience, the people who do use that option of creating an insurance policy to replace basically the state unemployment program, they're doing so because they want to know exactly how much they're going to pay this year, the next year, the year after, and that's the insurance premium that they have agreed to with the insurance company. And that insurance policy is actually one of probably 2 or 3 ways 501c3s can alter their unemployment claims program to suit their internal needs. And that is actually what we do, and Adams, Thomas & Company helps us do that, those kinds of things. So if you have any other questions about that, Krista, you can email me, or I'll follow up with you afterwards. And if you have any other questions, I can get those answered for you. I don't know, Adam, did I answer that pretty well?
Absolutely, that was better than I could have done. So thank you, Mac. All right.
Adam, could you kind of expand on, so Thomas & Company provides unemployment outsourcing assistance. So what is it specifically that you guys would do to help your clients with fraudulent claims activities? What specifically kind of assistance do you all help identifying not only fraudulent claims, but I'm also aware of, with working with you all, that sometimes the state just makes a mistake and sends an inaccurate claim. Sometimes the math is just wrong. Can you talk about a little bit about how you all help identify those mistakes and those fraudulent claims?
Yes, absolutely. So within our process, we have a secure platform that clients utilize where they have login credentials and they go in and they respond to unemployment correspondence. So we get the claims, the decisions, the unemployment hearings, and we share all that communication within our secure system. Then we also receive those benefit charge notices that we talked about today. And because we have this claim activity and we receive those benefit charge notices, we can cross-reference all of that information and find any erroneous charges that have been made to the company. So if we show that, hey, we won this claim, but all of a sudden charges are showing up against you on the benefit charge notice, that's a red flag for us. We protest that on your behalf. And then again, as I mentioned, when that's credited back to you, it'll show up on the following charge statement or that bill. So we always want to make sure that by having a centralized process with all of the claim correspondence, the information sharing, we talked about the details and documentation, and doing everything right on the front end to give the state everything they need and using that expertise to know what they need. We also then on the back end have that safety net of looking and auditing all of the charges made against you. And again, if we find that the state made an error, we want to make sure to get that rectified.
Thank you. Yeah, that's actually one of my favorite numbers to get every year, is how much fraudulent and just state mistakes that we identify for our customers every year. It's one of my favorite numbers to get.
Yeah, and also I'll add, within our system, if you have confirmed that it is a potential fraud issue with your employee, and within our system, you can actually choose that as an option, that they're still active, it's a potential fraud issue. And what'll happen is our system will provide a link to that user in the system that takes them into directions that they can share with that associate or that employee that shows them exactly how to report that to the state agency. Here's steps you may need to take with the IRS. Here's how to report identity theft. So we also provide additional resources that can be shared with those individuals, because of course, if they find out, just like anybody would, that their identity's been stolen, that can be very stressful. And so we want to provide additional resources that can be shared with them to help ease some of that stress, and they don't have to go looking for it themselves.
Absolutely. Yeah, and all of our customers appreciate having that access to all of that stuff that you all provide. I'm not seeing any more questions coming in. Last call before we send everybody off to their next meeting or possibly lunch. Have you eaten lunch yet, Adam?
I have not. That's on my to-do list right now after this.
Are you going salad? Are you going burrito? What are we doing today?
Oh, I mean, I'll probably go to Taco Bell or something. Who knows? I don't know.
That's awesome.
The $5 box calls my name sometimes.
Absolutely. Thank you. Amen to the $5.
Disclaimer: we are in no way associated with selling or
Taco
promoting Taco Bell.
Not at all. Well, I'll just go ahead and let everybody go. Thank you all for being here. We really appreciate you all joining us today. If you have any questions, you'll be getting an email from me later today. You can just reply to me and I'll be glad to either answer it myself or put you in touch with Adam's team and they can answer some of your questions as well. If you're waiting for that certification credit, I'll go ahead and have that survey pop up now and you guys can get your credit from us. Adam, thank you for joining me today. I really appreciate you being here.
Absolutely, anytime. Thank you, everyone.
Thanks, guys. Bye.